Welcome to the very first Financial Intelligence Deep Dive, our newest addition to the Intelligence Deep Dive series.
Great to be kicking this off.
Yeah. After a brief but honestly necessary break, we're back, and we've added this dedicated financial intelligence deep dive alongside our established daily intelligence reports.
It's packed with crucial insights.
It really is, so make sure you check it out. This is a milestone, our inaugural financial deep dive, and we're truly excited to share it with you. Today is Monday, August 11th, 2025.
And you can always follow us, right? YouTube, Spotify.
Exactly. Find us on YouTube at Nextsite Intelligence, and on Spotify, just search for Deep Dive Intelligence Deep Dive. Now, today's deep dive report, it comes to us from Nextsite. They're a global intelligence company really known for their in-depth analyses.
They do some impressive work. And they develop Site Connect too, right?
That's right. Their own open-source intelligence platform, Site Connect, which helps investigators worldwide. You can check them out at www.next-site.com.
Good stuff. And these reports they provide their customers, they're pretty detailed.
Very detailed and often customized to fit specific interests. So this is our regular daily deep dive, specifically the intelligence brief for Monday, August 11th, 2025.
And our mission today.
Our mission is to cut through the noise, and extract the most important nuggets of knowledge from this comprehensive financial intelligence briefing.
Okay, let's unpack this then. The executive summary. It starts with something interesting. Global markets seem to be, well, shrugging off all this trade war talk and tariff headlines. Instead, they're actually edging higher. So what's driving this? It seems a bit counterintuitive.
It does on the surface, but what's truly illuminating here is how forward-looking markets are. They're inherently predictive, or try to be.
Right.
Investors aren't really dwelling on past headlines. They're clearly looking ahead, anticipating rate cuts from central banks. And their focus, it's intently fixed on that upcoming key U.S. inflation report.
Okay.
That strong expectation of, monetary easing is providing a powerful tailwind. It's effectively overshadowing the background noise from trade disputes. And we definitely saw that play out last week. U.S. equities, they closed near record highs on August 8th. The Dow Jones Industrial Average, the S&P 500, the NASDAQ Composite, all posting solid gains, what was it, between 0.5% and 1%.
That's right, a very robust close to the week.
Yeah.
And absolutely, looking beyond the U.S., Europe's STOXX 600 also gained about 0.2%, marking its strongest week in 3 months.
Okay.
And Japan's Nikkei 225 jumped, what was it, an impressive 1.85%?
Yeah.
Largely thanks to getting some clarity on those U.S. auto tariffs.
So it paints a picture of broad market optimism then, though maybe with different reasons in different regions.
Exactly. Distinct regional drivers, but overall optimism seems to be the theme.
Commodities, though, were a bit more of a mixed bag, weren't they?
They were. Gold futures hit a record during the week.
Before settling back a bit.
Yeah, settled back slightly at $3,491.30 per ounce. Meanwhile, Brent crude slipped down to $66.59 per barrel.
And currencies were pretty quiet?
Fairly quiet, yeah. The euro holding around 1.1645 against the dollar, and the yen trading near 0.0068 US dollars per Japanese yen.
So that difference in commodities, what's that telling us?
What's quite telling, gold's record high reflects that ongoing demand for safe havens amidst, geopolitical risks and maybe a weaker dollar outlook.
Okay.
While the dip in oil hints at supply increases coming online, plus maybe some potential de-escalation of tensions in Eastern Europe.
Makes sense. And treasuries.
Right. U.S. 10-year Treasury yields rose 3.9 basis points. That's just under 0.04% to 4.283%.
And that reflects the rate cut expectations, too.
Precisely. It reflects those very same expectations that the Federal Reserve will likely ease policy later in the year.
So what does this all mean for you, the listener? It sounds like while trade concerns are out there,
They are.
the market's immediate, almost singular attention is squarely on inflation data. That upcoming report could be a make-or-break moment for those rate cut hopes.
Absolutely critical. Tuesday's CPI is key.
Now, this broad market resilience is interesting, but if we sort of peel back the layers, are all parts of the market equally confident, or are there maybe some hidden cracks developing underneath?
That's the right question to ask.
Let's unpack the nuances within specific asset classes, because that's where the deeper story often lies, right?
Exactly. If we connect this to the bigger economic narrative, digging into these specific assets truly reveals how different sectors are reacting. You start to see where the market's true convictions and maybe vulnerabilities might be.
Okay, equities first. U.S. equities still near records, but the report sounds a clear warning about stretched valuations.
Very stretched.
The Dow, S&P 500, NASDAQ all closed near records with those gains on Friday, but analysts are sounding the alarm.
The S&P 500's price-to-earnings ratio is over 22.
22, compared to a long-term average of what, 15.8?
Yeah. That, for most experienced investors, sounds like a pretty significant yellow flag.
It absolutely does, and it raises that important question. How sustainable are these gains when the market is priced so richly?
Plus, August and September have historically been weak months for the S&P 500. Often see pullbacks then.
So that high PE multiple, it makes the market vulnerable.
Very vulnerable to a correction, especially if that July Consumer Price Index report, the CPI, comes in hotter than the expected 2.8% year-over-year increase.
Okay. Switching to Europe. It's interesting. Financials seem to be driving gains there.
Yeah, that's a key development. European stocks added about 0.2% on Friday, logged their largest weekly gain in 12 weeks, up 2% overall.
And why the surge?
The report points to upbeat earnings from banks, plus those growing expectations of European central bank interest rate cuts.
Right, the ECB easing.
Exactly.
Yeah.
In fact, the European banking index has rallied more than 56% this year.
Wow, 56%. That's huge.
It's truly significant outperformance, and it tells us a lot about market confidence in that sector.
Confidence in their resilience and profitability.
Yes, particularly as central banks across the Eurozone move towards easing. It's a key sign of broadening market strength, moving beyond just tech into more traditional industries.
Interesting. Okay, Asia Pacific. Japan's rallying mainly on tariff clarity, you said.
That's the main driver. Tokyo's Topix and Nikkei 225 surged after the U.S. agreed to cap auto tariffs at 15%.
Ah, the auto tariffs. That makes sense.
Plus, SoftBank had a profit rebound, which caused a huge jump in its shares. But mainland China stocks, they lagged behind.
Still worried about deflation and property weakness there.
Exactly. Those concerns are ongoing and weighing heavily.
So this really highlights the direct impact of trade policy, doesn't it? Clarity helps Japan.
Big time. Especially for an export-oriented economy. Clarity on tariffs, particularly for something like autos, is a clear benefit.
But conversely, China's internal issues are holding their markets back.
Right. Real estate, disinflationary pressures, those domestic problems are clearly weighing heavily, indicating quite different paths for regional performance right now.
Now, here's something I found really fascinating in the report. It gives you a window into investor psychology.
The flows.
Yeah, the investment flows. Global equity funds recorded net outflows of nearly $8 billion in the week to August 6th.
Outflows, okay.
And U.S. equity funds saw significant net sales of $13.7 billion. So the big question is, where did that money go?
And what's striking here is the immediate rotation. Investors poured a massive $135 billion into money market funds.
Wow, $135 billion.
And another $20.98 billion into bond funds.
So a clear shift to safer assets.
A very clear shift towards safer, more liquid assets. It's investors essentially parking cash, showing significant caution. It's that wait-and-see approach ahead of the U.S. inflation report and, the Fed's September meeting.
With the markets holding its breath.
Exactly, waiting for Tuesday's numbers.
Okay, let's talk fixed income. U.S. Treasuries, the 10-year yield climbed to 4.283%. The market's pricing in at least 2 Fed cuts by year-end, but a strong CPI could mess with that.
It certainly could delay or even temper those easing expectations. This dynamic just underscores the extreme sensitivity of bond yields to inflation expectations right now.
And in Europe, bonds were steadier.
Mostly steady, yeah. German bond yields near 2.7%, UK gilts around 4.603%, and Eurozone banks, as we mentioned, are benefiting from expectations the ECB will signal cuts soon.
Which would help their borrowing costs?
Exactly, potentially boosting profitability.
Okay, foreign exchange. The dollar index rose slightly last week. Euro slipped, yen weakened.
Right. Euro trading around 1.1645 against the dollar.
So if that U.S. CPI comes in hot on Tuesday,
any hawkish surprise could put more downward pressure on the euro-USD pair, particularly as the ECB is generally expected to adopt a more dovish tone soon.
and the yen, still weak.
Still weak, around a 147.8 per U.S. dollar. And interestingly, despite its prolonged weakness, Japanese authorities have notably not intervened. That's something to watch.
And the yuan.
Held near 7.18 per U.S. dollar. It's balancing those geopolitical tensions with hopes of more economic support from Beijing.
Okay, commodities and energy. Gold settled at $3,491.30 after hitting that record high.
Yeah, $3,534.10 was the high. Investors are clearly still drawn to gold as that traditional hedge against geopolitical risk and potential currency depreciation.
And oil. Brent crude closed lower.
Lower at $66.59 per barrel. Prices were notably pressured by talk of a potential ceasefire between Russia and Ukraine.
Suggesting less supply disruption risk.
Potentially. Plus, new U.S. tariffs on Russian buyers. And importantly, OPEC Plus agreed to raise production by 547,000 barrels per day for September.
Okay.
And U.S. rig counts edged up slightly, too. So all signals pointing towards increased supply.
Which pushed prices down. Brent fell 4.4%, WTI 5.1% over the week.
That's right. A significant shift in energy market dynamics just in the last week.
And other commodities. Copper was up?
Copper gained nearly 1%, partly on those China stimulus hopes. China's a huge consumer.
Right. And food prices.
Interestingly, the FAO Food Price Index rose to a 2-year high in July. That was driven by record meat prices and a surge in vegetable oils.
But cereal prices dropped.
Yes, cereal prices actually dropped to near 5-year lows, which is helping contain broader food inflation somewhat. Bit of a mixed picture there, too.
Now, the report mentioned a couple of data gaps. Crypto.
Yeah, an interesting intelligence gap. Comprehensive crypto data for August 10th wasn't readily accessible from their usual sources. We know Bitcoin hit a record high back in mid-July.
Right.
But current reliable daily August price data wasn't available for this specific deep dive.
And that gap itself is kind of insightful, isn't it?
It is. It reminds us that even now, certain volatile or less regulated markets, like crypto, can still present blind spots for comprehensive daily analysis.
And similarly for real estate.
Same issue. Daily data on global real estate markets wasn't available. Now, observers note that property markets, particularly in China and parts of the U.S., remain under pressure.
High borrowing costs, oversupply.
Exactly. But the lack of granular daily metrics in the brief means we'll just have to keep a closer eye on those longer-term trends in future reports.
Okay, let's shift focus now to the regional roundup and the big picture. What key risks and trends are actively shaping these diverse markets?
Yeah, this is where we really connect the dots, synthesize the information to understand the specific drivers and, importantly, vulnerabilities in different parts of the world and what that means for global stability.
Okay, America's first. U.S., the S&P 500 surged 28% since April lows, up 8% year to date, pushing that PE over 22, as we said.
A remarkable run.
But strategists at major firms, Morgan Stanley, Deutsche Bank, they're expecting a pullback.
They're openly expecting one, yes. Specifically pointing to August and September as those historically weak months for U.S. equities.
That historical seasonality, it's a critical factor, isn't it? The market knows about it.
Oh, absolutely. And the July CPI due Tuesday expected at 2.8% year over year, if that comes in hotter.
It could temper those rate cut expectations.
Significantly. Even though futures are currently indicating over a 90% probability of a cut in September, mainly due to recent weaker jobs data, the market is really walking a tightrope here.
And those big outflows from U.S. equity funds we talked about.
$13.7 billion out.
While money markets saw that massive $135 billion inflow, it really underscores the caution, doesn't it?
It absolutely does. It's like investors collectively hit the pause button.
Okay, EMEA, Europe, Middle East, Africa. Europe's STOXX 600 up over 2% last week, led by banks.
Right. Robust earnings, optimism about policy easing, and also improved sentiment on speculation of a potential Russia-Ukraine ceasefire playing a role there.
So the recovery in Europe seems to be broadening, beyond just growth stocks.
It appears so. Financials playing a major role is often seen as a sign of a healthier, broader market recovery. German bond yields held steady. UK gilt yields slipped a bit.
Rate expectations softening.
Yes, after a series of weaker economic data points over there, markets are increasingly pricing in an ECB cut later in 2025. Suggests a growing belief the worst of the inflation fight might be behind them in Europe.
Asia Pacific, Japan, the standout. Topics past 3,000, Nikkei up nearly 2%, all because of those auto tariffs being capped.
That and SoftBank's return to profit led to big rallies for automakers like Toyota, Mazda, Subaru. It just illustrates the critical impact of direct trade policy clarity, especially for export nations.
And the weak yen helps their exporters, too.
It does provide a competitive boost, though it's something to watch for potential policy intervention if it weakens too much further.
But China, still subdued. Deflation, property stress.
Persisting concerns weighing heavily on sentiment. Investors are clearly looking for more decisive stimulus measures from Beijing. Still waiting.
So when we put it all together, synthesize all this, what are the overarching trends and risks shaping the global financial landscape right now?
Well, zooming out, Those cross-asset flows we discussed clearly show investors taking profits from equities, rotating into safer assets like bonds and cash.
Okay.
This widespread caution is being driven by, one, persistent tariff uncertainty, and two, critically, those high equity valuations. Bond funds seeing their largest inflow in 9 months, especially into short duration and higher yield Eurobonds, that strongly suggests widespread rate cut expectations are baked in.
And the surge into money market funds.
That just screams wait and see, a clear pause ahead of those pivotal inflation data releases, especially the U.S. CPI.
Okay, this leads us right to the risk map in the report. For you, the listener, what are the major catalysts, the big themes to watch closely in the coming days and weeks?
Okay, number one, without a doubt, U.S. inflation and Fed policy. Tuesday's July CPI is the big one. If it's higher than the expected 2.8% year over year.
Could delay rate cuts, push yields up, weigh on stocks.
Exactly. It could significantly disrupt the current narrative. A softer print, however, could strongly reinforce the rally. It's that pivotal.
Okay, what else?
Second, trade and tariff tensions. The U.S. recently imposed higher import duties, raising average tariffs to, believe it or not, century highs.
Wow.
Prolonged hikes risk stoking inflation and slowing global growth. Auto and tech stocks are particularly sensitive here.
Got it. Geopolitics.
Still a major theme, specifically Russia-Ukraine. That speculation about a ceasefire helped equities and pressured oil, as we saw. A confirmed ceasefire would likely ease supply disruptions, reduce risk premiums.
But failure could reignite volatility.
Quickly, third, valuations and seasonality. The S&P 500's high PE ratio plus the historical weakness of August-September. It just increases sensitivity to any disappointments. Could trigger a correction.
And finally, China.
Yes, China's ongoing slowdown. Weak factory gate and consumer prices, the property stress is weighing on their markets, and continued weakness there could dampen global demand and hurt commodity markets worldwide. It's all interconnected.
Okay. As we wrap up this deep dive, always good to look at the immediate horizon. The report gives us a handy event calendar for this week, August 11th through 15th, 2025.
Indeed. These are the specific data points and events that could move markets, offering fresh insights. Monday, you've got the tentative OPEC monthly market report could influence crude.
Tuesday, the big one.
Tuesday, the crucial U.S. Consumer Price Index for July, arguably the most anticipated release of the week.
Then Wednesday.
U.S. federal budget statement. Thursday, the U.S. Producer Price Index, or PPI, that's a key indicator for pipeline inflation.
And Friday.
Friday, the preliminary University of Michigan Consumer Sentiment Report gives us a pulse on consumer confidence. Each one offers a unique lens and could shift market expectations.
So what's the big takeaway then? The enduring thought for you, our listener, as you start the week and process all this financial intelligence?
I think the key insight here really is the delicate balance investors are facing right now. You have a market propelled higher by this powerful anticipation of rate cuts. Yet simultaneously, it's flashing these clear warning signs from stretched valuations and historical seasonal weakness.
So the question is how to navigate that.
Exactly. How does one strategically navigate this tension between the feel-good rally, and these underlying signals of caution? Especially when critical inflation data is literally just days away. It's about discerning where the true conviction lies versus where the market might be, perhaps, getting a little ahead of itself.
A really important point to consider. Well, don't forget to follow us on YouTube and Spotify. Also, like, share, and comment. We really do look forward to hearing your opinion.
Definitely.
This is it for today. Enjoy your start of the week.